What's up, bro? What's up? Can you hear me? So I'm actually gonna do markups today on my terminal, just to I'm not gonna do any simulations.
Hey, Misha.
What's up, man? What's up?
Good. How was the day?
It's been pretty good. I mean, the thing that Ant did was wrong, but then again, I mean, I'm not really stressed about it because they have the notes. They don't have
Yeah.
the teaching. So I'm gonna for,
Exactly.
For some reason today, on my demo, I was feeling kind of like the same way I was feeling when I was trading on my real cash.
mhm.
Is it you? Shut up, speaking the song.
I keep hopping on the trade and going out so quick.
Yeah, I'm gonna go over some basic ICT stuff, and then we're gonna get into the how to hold trades long term. So this is recorded, so I'm gonna
Oh, okay.
um yeah, pull out my. There's a lot of stuff that we got to go over, but I'm gonna start with just the basic price theories and explain what they are. So actually, I'm gonna do this on because I can't. I can't type in the
Why can't you
actually,
type?
yeah, I can. I can type. Let me see.
Sorry, my end is a bit noisy. Yes, I'm just going to mute myself, okay?
Yeah, that's fine. That's fine. That's fine.
The kids, they're just playing, that's why.
Yeah, I know, kids. I remember when I was a kid, my dad would have to shut us up when he was on his meetings. Okay, I mean, this isn't really, I don't like this one that much, so I'm gonna actually close this. If this will close, it's not responding. It better respond. Okay, so we're actually just gonna do this on Trading View because I like Trading View with that. Get out. Jeez, you guys are always on with something. Like you never do this when I'm not home. Okay. So we'll get right into it, and I'll go over a few stuff and how to understand. Like when I start saying terminology, people get confused and they're like, "What the hell is this dude talking about?" But we just got a new Wi-Fi, and my landlord, I don't know, this Wi-Fi is kind of slow, but okay. So the first thing we're going to talk about is a breaker block. So I'm going to start typing out some terminologies and then we'll go over them. So a breaker block, it's not the same as an order block, but basically in simplicity, a breaker block is in the bullish market, in a bearish market, I gotta let somebody in. Bearish market. A breaker block is the last down candle in an overall down retest for the successive buy. So successive buy and then the aggressive sell. So in a bearish market, a breaker block is the last down candle in an overall down retest move for a successive buy and then an aggressive sell. So I'm going to show what that is in hindsight. But basically, a breaker is simply, for instance, right here. So this is a breaker block right here. This candle, let me highlight it. This candle right here. I'm actually going to change this to a breakout. So this candle right here is a breaker block. It is the last down move, the last down candle in a successive, in the overall down retest move for the successive buy and then an aggressive sell. So this guy right here is a breaker block. And the reason it's a breaker is because if this guy's broken, for instance, if he's broken after an aggressive move, you're either in really deep internal liquidity. I'll be saying some terms as well, but you're either in really deep internal liquidity catch or you're actually going up to collect the highs. So this is basically the first line of defense of like a successful sell. And if we go, I have this highlighted here, but let's go on a 1 hour real quick, and then let me just zoom out. I should have highlighted what day that was. Oh yeah, we're getting close. Right here. So this whole move right here is that bigger breaker block, this guy, right? So before this drop, there's a breaker block here. There's several breaker blocks you can see in this move, actually. So let's start over here. So this whole thing is actually known as a turtle soup liquidity run. So it basically just comes up, take out the liquidity at the top, and then tank. But we can find several breaker blocks here. So this guy right here is a breaker block. It is the last down move in a successive buy before the tank. You can consider this a breaker as well because it is the last down move before a successive buy before the tank. So basically a breaker is like an institutional zone where there's hedging. So if you see a breaker, like for instance, breakers are good ways to start adding different positions to go the opposite way. So this is a breaker. So if I was looking at this and I was in, and I know that I'm in a sell side liquidity run, I will use that breaker as a place to put to hedge my shorts. So for instance here, this last candle here is a breaker. So I would come over here. Let me draw it out real quick. I would add my shorts here. I would add my shorts here. And then even here as well. Eventually, till we have, and then I'll add more shorts here as well. So you can see how these breakers are actually really good inclinations for like continuation of patterns and other stuff. So when you see this breaker, you're thinking about if you're in the internal side liquidity or external side liquidity. And then I'll talk more about that. But for now, I just want you guys to understand what that concept is. It's just in a bearish market, a breaker block is the last down candle in the overall down retest for the successive buy. So, and then the opposite goes for a breaker block in the bullish market. So let's find a really good one. There's a bunch over here, but I want to find a good one. Like for instance, right here. So in the bullish market, a breaker block is the last up candle in an overall up retest move for the successive sell and then an aggressive buy. So let's take a look at that. So in the bullish market, the last up candle in an overall retest for a successive sell before an aggressive buy. So this is a breaker right here. This guy is a breaker block because it is the last up candle before a successful sell and then an aggressive buy. So we can use that area to start adding positions too. So I mean, we could have went here because the wick of that guy is what was tested. We could have added more longs here. I mean, I wouldn't have added longs here, but this is something I would hold for if I was in a trade for like a few months, I would hold this. Could have added one right here. Basically, breakers are really good segue points for hedging your positions to go long or shorts. Right here as well. So here's that last up move before a successive drop and then the aggressive buy. So right here, boom, I would have added more. So breakers are good places to use for hedging your longs or shorts in an internal liquidity run. And then I'll tell you guys the difference between that. There's a difference between internal and external. During an external liquidity run, a breaker block will not hold up. It will get blown through and it will not, your trade will not hold up. But in an external liquidity run, breaker blocks become mitigation. I mean, in an external liquidity runs are just going for liquidities either at the highs or lows. So breaker blocks, order blocks, all those stuff don't matter to the move because the move is seeking liquidity. It will not go after those internal guys. So once you understand where the market's going, you know the difference between internal and external liquidity runs. Then you understand if it's going to fill in a breaker or if it's going to fill in a fair value gap or fair value void or liquidity void or an order block. Then you understand when to use those things, but we'll start at it small at a time. So what is an order block? Let's go on. Actually, I'm going to show you guys on the daily just because I like the daily does a better job. So an order block in a bullish market is the last down candle before the move up. When the price comes back down to that order block, look for opportunity for longs. So sometimes it's hard to see, it's hard to tell, but a succession of down candles can be a whole order block. For instance, this whole thing right here is an order block. This whole down move is an order block. You can't see it. This is October 8th, 2019. So let's go to October 8th, 2019, right here. So now you can see it. This last down candle is an order block right here. You can't see that it was tested here on the weekly. Actually, if you have eyes, you can see it. But here it is right here. This is where that retest right here. This candle right here was where that retest happened, right at the order block. And then down. Now the mean threshold, there's mean thresholds of candles. There's a mean threshold of a breaker block, and there's a mean threshold of an order block. But knowing what types of order blocks you're looking at or breakers is important. If the candle's body is majority of the down move, then it's a body breaker or a body order. So this is a body order block, meaning if I wanted to get it on a retest, I would get in at the top of the body. Now, if it's a wick order block, like majority of the body is a wick or majority of the down move is wicks, then I would get in at the main threshold, which is the 50%. And there's specific rules for that, but we'll get better at getting in on the main thresholds and all that stuff. But this down move was then successful with an up move. Imagine catching this for 2 weeks. This is actually for a month. If you would have caught this move, say you would have gotten in, you saw this, and then you caught this retest, you would have been in for about 900 pips, and you would have held it for about 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So that's about almost 2 months, 2 months and 1 week. So you would have held this for 9 weeks and you would have made 900 pips. That's just off one move. Now, if you know where the move is going, you would just be adding positions as you go. just how I'm doing with this gold trade that I'm in right now, because I already know where the move is going. I'm just adding positions as we go. We'll get better at that, and we'll understand why we're adding positions. So the next thing is a turtle soup, a liquidity run. Actually, I didn't talk about a bearish order block. So this is a bullish order block, which is the last down move before the buy. A bearish order block is the last up move before the buy. You guys can spot it right here, actually. Here's that last up move before the sell. I mean, not the buy, sorry. The last up move before the sell. That bearish order block will be retested. Once it's retested, you can look for positions to sell. Now, if you would have gotten in here, you would have held it for about, I think this is like 300 pips or something. 500 pips almost. 587 pips. Now, like I was saying, this is a body order block, so I wouldn't be getting at the mean threshold. My stop loss would be slightly above that, but I would be getting in at the body of this candle right here. And that's exactly, everything is algorithmic. So it's known for a purpose. They do this for a reason. They don't just, it's not random. So once you understand this, you can actually get confident in the market. So this is an order block. And the reason why this was retested is because this is an internal liquidity run. So after it did a turtle soup here, turtle soup is basically when they come and take the lows and then put longs, add longs or shorts. And I know that this move was a run on liquidity to the buy side. The external liquidity is longs, but in order for that to happen, we had the highest cut right here. So the internal liquidity now is to take out order blocks and others. We'll get better at that, but that's why I'm shorting GU for a few weeks, and then I will be going long for months. But we won't discuss that right now. A turtle soup liquidity run, like I was saying, is simply it's better to see on the daily. The daily has some really good examples of turtle soup's liquidity runs. So a turtle soup liquidity run is simply just a break on the highs before a tank or something. So there's liquidity at the top right here. Banks come in and they, remember what I was saying, banks come in and they sell to willing participants before they can take the market. So they sell their longs to retail traders who have their stops up here, who have no idea that it's coming before they tank the market. And they'll do that both on the sell side and the buy side, depending on if you're on internal or external liquidity. That is very important that you need to know the difference, but we'll get to that as we keep going on. Internal, external liquidity is more of a complicated subject. So we'll right here as well. So here's the short, here's the lows. They came and they sold. I mean, so they sell to willing participants and then buy the move. So they sold their prices to willing participants. This is retail. They got their stops down here like some idiots, and then they bought in the direction that they were meant to be. You will see this in all time frames. That is considered as fractal, price fractaling, or price fractal, which is where the bigger time frames happen and then the small time frames repeat what the big time frames are doing. That's just time fractal. You'll see it continually over and over. They all repeat themselves. And then once your eyes get used to it, you're like, oh, shoot. Now, a mitigation block in a bullish market, a mitigation block is a candle that retested in the opposite market, meaning if you're in a bullish market, a mitigation candle or a mitigation block will be a bearish order block that is retested and continues to buy. So let's show an example of that. So this guy right here. So remember how I was saying this last down move, there was a bullish order block and then price came and retested it and it bought. Now in the sell side of that market, this guy is now considered a mitigation block because in that area, that's where the banks started using that area to hedge their shorts. So they're adding positions to the short right here because they always want to make money back from where they were last time. So if they're going long, if they were hedging here to go long, they're gonna hedge here to go short. If they're hedging one place to go long, they're gonna hedge somewhere to go short. It's repeating itself over and over. So let's go back for a little bit, and I'll actually show you guys there. So right here, this move right here is an order block. But if on the other side, it's considered a mitigation block because they were hedging here to go long, and then they came here, they started hedging here to go short because they used this mitigation block here as a place of interest to short. And it's like that every single time. They'll do that in every single market, both externally and internally. So let's look at this. Look for more better examples right here as well. Here's an order block right here. Came down and retested it and then bought. And then when you come over to here, here's the mitigation block. So this turns into a mitigation block and is now being retested for the short. It may not be perfect all the time, but these guys will retest in areas that's so obvious. It's obvious to people who know what they're looking at, but it's not obvious to retail or anyone else who doesn't know how to read it. So there's an order block right here. Market comes down, trades into it, and it buys. And then it comes right back down here. Look at this area right here. So remember how this is the last down move before the buy? This mitigation block turns it into the last up move before the sell. They do this all the time. They'll do this to basically make back profits from their sells or their shorts or their longs. So they can mitigate prices. They're basically selfish in a sense. These banks are straight up selfish. So a vacuum block is a gap that is created in price action as a result of a volatility event. The gap forms from a vacuum of liquidity directly related to an event. So you don't really see them in like really good markets. You see them on like the daily chart and the weekly charts, and sometimes even the 1 minute and the 5 minute charts. But basically, they're gaps in the market that price. So, for instance, you'll know if there's a gap. For instance, if it doesn't open right when it's closed, this is not a gap. I'm trying to look for a really good one. But basically, on Sundays, you guys know how that market gaps up or it gaps down. There's a high percent chance that that gap will be filled before continuing either externally or internally to seek liquidity. And we'll get better at that and figuring out what that means. But in summary, basically, when that market gaps up, there's no trading in there. So let me draw this. Bear with me. So for instance, say you have a bullish market, price will do this, come down, and then it gaps up, price starts trading here, it'll eventually come back down, fill in that gap before it can continue up. That's because they need to do that in order to make up for this area that wasn't traded into. So this area here is called a gap. Now don't confuse this with a liquidity void where price just sells and there's no trading in there. Like for instance, this is a liquidity void. This is a liquidity void right here. This is a gap void or a vacuum block because there's absolutely no price at all. Right here you see price, it's selling. Right here you don't see price. It's literally a up move and then you don't see anyone trading and then it just starts here. And this happens during Sunday openings because they need to gap prices. So from what they were doing previously, the previous days, so then they can come back and mitigate into that. And that's what I use the term mitigate a lot, because they come back into those prices to make their money back before they can continue. And you guys will start to see that over and over and over, and you're like, oh shoot, like it's literally repeating itself. So if we're in a bullish market, we want to see if there's any bullish order blocks that want to prevent the gap from filling in. When price trades into that order block while a gap is present, you want to see an immediate reaction right away. So for instance, this is an order block right here, right? So this is the last down move before the buy, right? But in between that order block is a vacuum gap or a vacuum block where there's no trading, right? So what you would want to see in this example, we didn't see that. Let me delete this. In this example, you didn't really see it like that, but where's my price came? If this order block was legit, you would want to see a rejection right away. But in some instances, you will see price come and fill that gap in all the way and even go to the 50% of this order block right here, the mean threshold, before it buys. So the best instance is to just wait until it's filled in and then catch the move up. Don't try to catch it while I hit the order block, unless it's like a monthly or a daily order block on an internal liquidity run. I will keep saying that because you guys have to keep that in mind. Internal liquidity runs are when price value fair value gaps, liquidity voids, order blocks, mitigation blocks, and they value all the price techniques. But an external liquidity run, like when it's doing a turtle soup sell model or turtle soup buy model, it does not care about those things. It'll run right through it. That's why sometimes you see when you have like your buy limits at order blocks, and you don't understand that it's a external liquidity run, meaning it's going for liquidity at the bottom. They will take out. They don't care if you have an order block right there. They're going for the liquidity at the bottom. So once you understand what you're looking at, then you know, oh, this is a liquidity run. They don't care about the other stuff. So, but let's continue. What's next? If you have any questions at all, you guys can always unmute yourself and ask a question. But let's continue. What is an exhaustion block? In simplicity, an exhaustion block is simply the last momentum in a trend before a massive reversal. It is a vacuum gap, for instance. So let's say you're at the very peak of price and they're just consolidating. And then what you'll see is this thing here where it comes up and then it gaps up and then it just drops, like goes to hell. This area here is the last push in momentum, meaning the last push up or down if you're in a bearish market. So if you're in a bearish market, it's the last push up where there's no trading. For instance, there's absolutely no trading in here. It's not the same as a liquidity void. Do not confuse it with a liquidity void. There's absolutely no candles in here. It's just a straight gap where they push price up one last time before they fill it in and then continue to sell. We'll talk about liquidity voids here in a second. A propulsion candle. Now, a propulsion candle in a bullish market is a propulsion candle is an order block within an order block. So that sounds confusing, and that sounds like, what the hell do you mean? It's an order block within an order block. So in simplicity, it's just an order block that is used as a role of price support for higher run on liquidity or lower run on liquidity. So here's a great example right here. So this whole move from right here to right here is in fact an order block. So if I go on the monthly, this guy is an order block. This whole down move for 3 weeks, this is an order block. However, this last down candle right here, this guy is a repulsion candle because as soon as you can see it right here. So as soon as price hit that, it repulsed price out of its way. Now, my best entries are on the repulsion candles, not order blocks, because the reason for that is because repulsion candles, usually price does not go to the main threshold. Price can go to the main threshold, but you want an instant rejection, meaning 100% of the time, if you think something is a repulsion candle, you should have the main threshold, which is the 50% of that fib. Remember what I was saying this is a body repulsion candle, meaning majority of the move, it's body. So the 50% of that would be my like haven. Now notice how price right here. So notice how price came up. It touched the 50% and then instant rejection right here. So it came down, instant rejection. It did not stay in this area for long because this is in fact an accurate repulsion candle. Instant rejection and price bought away from it. And then price came and tested back into the highs of that. Eventually it kept going and going. And then after it tested back into this order block here. But it doesn't really test really good into this order block. But before it ended up testing back, I guess it was testing this guy here. But this is a repulsion candle as well here too. For instance, this guy right here. So here's this guy here. This guy right here is, you can measure it to see if he's majority candle or majority wick. So it's 158 pips wick plus this bottom wick. Always add the 2 wicks. So 158 plus 44, that's about almost 200. So it's majority wick. So I'm going to go from this top to the bottom of the wick. Now look, here's the 50% right here. Notice how price came down into that 50%, didn't go below it, rejected it instantly, came back down. This might have been some aggressive news or something that happened that day. Price came down to that 50%, did not break it, instantly rejected it, and then kept buying. That's how you know this is in fact a repulsion candle. But the overall move, the overall order block is this guy right here. So in simplicity, a repulsion candle is just the last down move, the last down candle in the specific time frame that you're in. And if you wanna be like, okay, I want to see if this move is legitimately a buy. So you'll look at the repulsion candle or the candle that you think it's a repulsion candle. Have your stop loss slightly under the 50%. If it breaks through and it closes, the body closes under that 50%, then you know for a fact this move is going to keep selling. That's what I use for that's what I use as my safety net. The repulsion candle is the ultimate and the best safety net to be in the market. Like it lets you know if you're on the wrong side of the market, you need to get out if you get a close under the 50%. But you need to know the difference between a candle repulsion block and a wick repulsion block. Notice how this was a wick repulsion block because majority of the move is a wick. So I go from the top of the wick all the way to the bottom and the 50% is there. It was rejected. Now, if this was a body like this guy here, majority of the move would be at the top, but also the 50% will be tested as well. You don't count this candle next to it because that is the move that initiates this. It confirms this move as a repulsion or it confirms this as an order block. And then notice how price came and tested it, rejected it instantly. Came back down, tested it once, tested it twice, rejected it instantly. You will see that you should not see price trade anywhere deep past the 50%. Even that includes wick. If it trades deep past the 50%, like down to like more like the 70% range, so from here to here, actually wrong. Let me go from here to here. So if price trades down to here, automatically get out. That price market's going to keep selling. So you can just from that information, you can reduce your losses instantly, like massively instant, without taking massive losses. So this guy right here. So there are sometimes when price will trade into it. Like for instance, this right here, I would have gotten out because I'm in this trade for 2 weeks. Here's my repulsion candle right here. It's my safety net. My 50% is here. I mean, this didn't really go past the 50. I wouldn't be so anal about it until it breaks this guy here. So the reason why I'm looking at this and not this guy is because this wick did not pass this. Because if this wick did pass this guy here, this one here, then this guy, even though it's a white candle, it will be considered a repulsion candle, therefore would be used as my safety net. But since this guy is the lowest point, the lowest down candle before the up move, he is the safety net. Notice how price came, rejected it, came closed under it, but it didn't close under it completely, came down, played in this guy, and then rejected it instantly. I would have gotten out just because I wouldn't waste my time in that market because it retested an area that I didn't want it to. Here's another repulsion candle right here. This guy right here. This last down move. And this guy is majority candle. Once you get better at it, you notice that, oh, this is majority wick, because if you add the two wicks together, so that's 92 plus 52. 92 plus 52. And then this is only 96. So I know it's a wick repulsion candle. So I'm going to measure from the high to the low. Here's that 50%. I don't want price to break below this. Here's that 50%. Price came. Notice how, since majority of this move is in the wick, I do anticipate price to test this wick, not the body, because majority of the move is in the wick. So majority of this move is in the wick. Therefore, I would be anticipating my longs in the wick. So I would be longing at the wick. My stop loss would be slightly here, under here, like right here. Now, I know this is a massive, you wouldn't be trading this on the damn weekly, but this is how you would do it on like the hourly or the 30-minute, just to set your safety nets. You reduce your losses by like 15, 20 pips. Same thing right here. This is a repulsion. This is the repulsion candle. This is a perfect repulsion candle, actually. Let me show you guys. So this candle here is like majority of it. Actually, it's this candle here from this high to this low. So majority of this candle is a wick, right? Here's that 50%. Remember, you don't count the candle next to it unless it has a lower low, and then you would use this candle. But here it is right here. I got this candle right here is what we're using. This candle does not count because that is the candle that confirms this guy here. This guy tested, came up. It tested it, came up, and then it just kept buying, kept buying. So you'll get better at seeing those, but you need to understand the difference between a repulsion candle and an order block. An order block is the consecutive move. Consecutive move. Anyways, let's go to the next one. Liquidity voids. Now we're going to talk about liquidity voids. You need to know the difference between a liquidity void and a vacuum gap, or this is a liquidity void where price did not fill in and there was successive selling without any retest at all. So from here to here, and this will eventually get filled. Now you can't tell exactly when it's going to get filled, but just know it will get filled, and it's going to get filled probably in a few years. This is the weekly, but eventually this guy will get filled. They will make their money back. We can see we'll find good other examples of. I mean, I was teaching this, so this isn't considered a liquidity void, but this move right here, this candle right here, is a liquidity void. So right here, there was no rest at all taken. Notice how it came here, came down here, did not fill it in until eventually. So this was back in 2009. It got filled back in 2010. And you'll find a bunch of these. So here's another one. This was back in 2013. It got filled back in June, late June. So you get better and better at price as you at noticing stuff as you go and you continue. Same thing right here. Here's that liquidity void. Let me extend this. So when you're doing this void thing, you want to start from the wick to the recent price. So price came down and wicked, and then it dropped down. It touched it here, but it never filled this guy in. It was just straight selling, and it didn't fill it in. It almost filled it in here, and then they eventually filled it in back in 2018. So you would have held, I mean, you got in, say you got in this buy, you notice that it's going for this high. You'd have gotten in a 2017. This is how big banks hold trades because they know where they're going for and they know what they're looking for. But you can do this on a smaller time frames and hold stuff for days. You don't have to hold it for years. I don't know. I'm not waiting for years. I'm a weekly trader. I get in, I hold it for about 2 weeks now, and I'm done. That's it. But I'm not holding any trades for a year. That's shot. That's literally suicide. Anyways, I'm just checking my trades. Yeah, but now I just get in and I hold my trades, and because I know what I'm looking at and I know what I'm looking for. Anyways, let's continue. Let's go to the next one. So a liquidity void, before a liquidity void is created, there is always price imbalance. Price imbalance is just straight up consolidation. So where they're imbalancing price, they're getting ready, they're loading up, which means they're loading up they're hedging for a position, a long or short position. They're hedging right here to tank. They're hedging here. They hedged here to tank. And then they created this small liquidity void right here. It'll be small sometimes where price came, dropped, touched it, did not fill it in yet, came, filled it in with the wick, but it's not filled in just because the wick hit it. It needs to fill in with the body, and then eventually filled in back here in July of 2020. And but you need to know when I'm using these terms, you need to know what the hell I'm talking about. So let's keep looking over here to see. Remember, there's always a price imbalance before a liquidity void. So here's a price imbalance, and then a void follows. Here's a price imbalance, and then the void follows. It'll always do that. They'll always do that. Here's a price imbalance right here, and then the void follows. And they keep doing that over and over. They use those price imbalance to hedge your positions to either go longs or short. I might do this on the 4 hour just because this is a bigger time frame and I want you guys to see the moves longer. Now, what are fair value gaps? Fair value gaps, the concept fair value gap is specifically used for internal liquidity only. Meaning, if you're in the external liquidity market, meaning if you're going for highs or lows and you're trying to collect those liquidity, fair value gaps do not matter because they don't care about fair value gap. They will blow through it and they will go and take the lows or the highs. So you need to understand that. In the internal liquidity run, they will respect fair value gaps and they will continue to respect it until they're in the external liquidity run. And then that's when they don't give a damn about liquidity, fair value gaps, order blocks, or any of those other concepts because they don't care about those support systems. That's when retail support does not matter anymore because they know they're on a liquidity run and they're not worried about that stuff. They're trying to get their liquidity so they can tank the market or long it. And they'll always do that. And you guys need to understand the difference between longs and shorts. In the long market, when you're on a long, so we call it the turtle soup buy model. So the turtle soup buy model. So let me type it up. So you'll see this turtle soup buy model. You'll see TSBM. I'll use acronyms a lot in the group, like in the free groups and stuff, because other people won't understand it, but you guys will. A turtle soup buy model is simply a run on liquidity. And I'll show you why they didn't give a damn about a fair value gap here. So for instance, right here, here's a fair value. So in simplicity, a fair value gap is a range in price delivery where one side of market liquidity is offered and is typically confirmed with a liquidity void on a lower time frame. So when you get better at it, you can see it. But in instance, this is a fair value gap right here. This is a fair value gap right here. And then there was liquidity at the bottom right here. Notice how it was filled in by the body. They will always fill it in by the body. You know it's a fair value gap when it fills in with the body. So if it comes and hits the top and it rejects it, it's not a fair value gap. If it comes and fills in the body, notice how it comes, it literally comes and fills in this whole body, then it's a fair value gap. Same thing, you guys can't see it now, but you get better at spotting them. So these wicks that are created, these are fair value gaps. This is a fair value gap right here. Notice how it came down. This guy right here, you can't tell, but it's a body before the body. You'll get better at spotting it. Same thing right here. This is a fair value gap. The reason why this is a fair value gap is because we're in internal liquidity run. So internal in a sense means we're just retesting for the externally run. So this was all just retest for the overall move sell. So internally, we're targeting all the fair value gaps and everything, but externally, we don't give a damn about them anymore. So for instance, this is perfect actually. So this is a buy model, a turtle soup buy model. So price comes down, take out the lows, liquidity, and then we get into the internal run. An internal run. Now I know this is on a 4-hour, but you gotta imagine how massive this has to be for these banks to be doing this, because in the internal run, they'll go and collect liquidity. How do they do internal liquidity? They got to fill in this fair value gap right here. They got to respect this order block right here. They're going to come and eventually respect this guy here, and even stay away from 50%. Remember, what candle is this? What candle is this? So in an internal market, repulsion candles, order blocks, fair value gaps are respected. Notice how this is a repulsion candle. Price came, 50% rejected. It never broke through that because this is an internal run. If this was an external liquidity run, this fair value gap means jack. It'll blow through it and create a turtle soup situation and then tank the market. But they didn't do that here because this is an internal run and they're actually just going to collect internal liquidity before going for external liquidity. So here's external liquidity right here. Here are the lows. So they came and collect the internal liquidity, 50% respected, and then they tank the market. Now, if you're seeing this and you know that the internal liquidity has been collected, you're like, okay, so now they're going on an external run. I don't care about these order blocks because I know they're going to take out the lows. These order blocks, these fair value gaps don't mean jack. The fair value gaps will get filled in external runs, but they don't mean anything. I'm not focused on them because I know externally we're targeting the lows. You'll get better at it. So this is let me go to the daily so you guys can understand this better, because when you understand what's an external and internal run, you get better at understanding what the hell you're looking at, what the market's doing. So usually what I do, if I'm actually, to be fair, so starting here, you always start on the monthly. So if I'm looking at this, I know that these highs were cleared. So if I'm just getting into the market and I see price come up to here, I'm like, okay, so this was an external liquidity run for the highs. So I know I'm in a buy side market where we took out highs and we're continuing up. So what I would be doing is looking for internal price action and then to continue to take out the highs up here. So what I would be doing, I would be coming in to fill in any liquidity voids or order blocks that are in here somewhere to continue to take out price. Because internally, here's that old highs right here. Because I know that externally this liquidity was collected. So now we're entering internal price action. So here's price action right here. This can sometimes be like consolidation or equilibrium. And we come into that internal area, which means we took out, say we took out the highs. We came down, internal, came and took out these highs. And then we came back into internal where we respected the order blocks and stuff. And then we went to take out the highs. This is how the banks do it. They go from internal to external, from internal to external. They'll do that all the time. That's why I know for a fact that gold is externally selling because it's going after, it doesn't give a damn about order blocks. And we'll go over that here soon. But so this was an external liquidity run. And how I know it's an external liquidity run is because we came and collected the liquidity at the top. And then I would be looking to go long here. So since this is on a month, every time price would come back into like an order block or a fair value gap, I would be going long. For instance, price came, we broke, price came down into this area, boom, I would just look for longs. But eventually that internal or will turn into external. So right here, price broke here, price broke. So everything I'm looking at, every retest that's in this market is literally just internal retest for the ultimate tank. And it's so crazy that, so here's that equilibrium price right here. It respects equilibrium, fair value gaps, breaker blocks, and everything. So we can actually see over here, here's that breaker right here. So here's that breaker block. Remember how I said this last down move before a successive, so it's a last down move. This is a bearish breaker. This is the last down move before a successive buy and then the ultimate sell. That's a confirmation that I am now in. Once I break this externally, I take out these lows and these lows. I know that now I'm in internal markets and I'm going for either the first target you want to target is equilibrium. I'm targeting equilibrium. If I continue that, I'm going to target fair value gaps. So here's a fair value gaps right here. And then eventually I'm going to target order blocks. So it goes in that order. You target the equilibrium price, then you target fair value gaps, then you target order blocks or breakers. And your breakers should be your last line of defense if this is in fact an internal run and then you want to sell. But we can see that equilibrium was actually where price hit and it sold off. So it'll hit one of those three things before it tanks. And then it sells off and then it takes out the lows again. Takes out the low again. So I know that everything in here is simply going to be a retest for the continuation of the sell. That's why I'm saying this next buy that's coming in, this massive buy that's going to come in GU for the next few years is simply just a retest. So here's that from here, from this high to this low. Here's that equilibrium right here. Let me move this here. So our first target, look at that. Our first target, even though it looks like we're going for these highs, but it's simply just a retest on the monthly. And when you get better at it, you'll understand. So it'll take out these highs. It now has become, on this smaller move, it has now become an external run. So it externally took out the liquidity at the top. Now it's going to return to internal. And then it's going to go up to external again until it fills in liquidity voids fair value gaps, and then it hits this order block right here, and this is that 50%. And when you get better at it, you'll be like, what the hell? That's so crazy. So here's this guy right here. Here's this last up candle. This is that repulsion candle right here. Here's the 50%. So my last line of defense when price returns up to here will be this 50%. If price breaks it, then I know for a fact that now we are in external market and we're targeting these highs. So everything else, like the voids and all that order block crap, don't mean jack to me anymore. But now this is on the monthly. So let me go on the hourly. You get a better perspective on the hourly. You can do this on the hourly and just catch moves. So here are the highs. It's really simple. It's really simple when you see it. Here are the highs, right? The liquidity was collected at the high. So I know any retest in here is a retest either to equilibrium, fair value gaps, or equilibrium, fair value gaps, order blocks, or repulsion candles. I know that for a fact. This right here, this right here is an order block. You can't tell, but this was that last down move. Remember how I was saying they're hedging, so they hedge right here. This was that last down move. So I know now I'm in internal liquidity run, which means there's no reason I should be expecting price to go all the way under here because I'm in an internal liquidity run. Therefore, if I come to this, I have more confidence that we will be going up to take out these highs. Because once you come into internal runs and you come to the liquidity, you collect the liquidity on the internal side, you will continue into external run until it turns into external overall. So I keep going up the highs, and now my next highs are here. And I know every time it comes down, it's simply a retest for that continuation up. Literally, they literally repeat themselves over and over. So here's the lows. This has now become a sell side liquidity. It's still buy side liquidity actually because it came into the turtle soup, took out the lows, and then I would be looking. So if this was an actual sell, I would look to go short here because this is the last up candle. So if it breaks this candle, I'm like, okay, that confirms it. It is going after external liquidity still, and I'm still in this move. So if I would have gotten out here, most people would have been like, oh, I'll wait till I get to the highs. No, I have my repulsion candle right here. Once it breaks to 50%, notice how it closes on that 50%. I would instantly go bullish from here because I know now it's going after external liquidity. It's no longer internal liquidity. So you can make one mistake and just correct it and boom, know the side of the market and just follow it. And it repeats itself over and over and over until it tells you like, hey, we're going externally now and we're going for the thing. So once again, here are the highs. So I know every retest in this is simply a retest for external liquidity. So notice how it came down. This is why this is important. So all retest is just internal liquidity retest. Notice how it came down to this repulsion candle. Or you could say this order block here because this was the last down move. And then the buy up. This up buy, this 2 consecutive hours of buy is confirming this order block. And then this guy here is the repulsion candle. So let's actually delete this and then measure him real quick. So from the top to the here. Notice how it came. Remember how I said this is a wick repulsion candle. So most of the move is where? At the wick. So I would be getting in at the wick of this candle. Notice how price came, wicked up. What I would be expecting if this is a X, since it collected internal liquidity, my target would have been up here, but I would have taken my profits at the breaker and then let it run. And then I would take it at the at the candle of this order block, and then eventually I would take it at the 50%. And if that 50% rejects it, then I know for a fact that we're now switching the other side of the market, and now we're on the sell side. So you get real good at understanding that, the difference between external and internal. But let's continue. I don't want to get into detail right now of external and internal liquidity. We'll get better at that. So the next topic we're going to go over is buy and sell side liquidity. I mean, buy market maker buy and sell models. So remember I was saying buy and sell models. So buy and sell models are always in the form of turtle soups, always. So if you're in a sell model, you'll get a turtle soup up to high, and then you'll sell. If you're in a buy model, you'll get a turtle soup to clear the lows, and then you'll buy. So right here, perfect example right here. So here are the lows. We're in a turtles. This is a buy model because I know it comes down. It externally took these lows out. So the market makers will always sell to willing participants before they buy. Remember that. And they will always buy to willing participants before they sell. So they will externally target lows in order to retest and then continue on the sell. And they will externally target the highs, and then they retest and continue the buys. So they will do this every single time. So when you have retail knowledge, you'll buy at every support or sell at every support. No, you need to understand what phase you're in, if you're in an external liquidity run or internal liquidity run. So once again, this is a internal. So it came, price came and clear out these lows. So I know, okay, so we're in the external liquidity run. That means we may be seeing price. I would expect price to go lower than this. So every time price, so we clear out the low, every time price retest, for instance, my order blocks, my fair value gaps and everything, I'm expecting to buy. I mean, I'm expecting to sell. So this was a retest, and I would sell here for a few days. This is why you can hold trade for days. This is simply it. Literally it. It's literally knowing the difference between external liquidity and internal liquidity. It's that simple. And when you get better at it, you'll be like, damn, okay, so we're on the sell side of the market. I'm gonna be looking to take out lows. I don't care about any retest that is a buy is a retest for the buy, not for a short term or a long term sell. So if I know I'm on the buy side of the market, any sell is simply a retest for the longs. And then if I'm on the sell side, any buy is simply a retest for the shorts. It's literally just like that. So here are these highs right here. Market will always buy to willing participant before it sells. Once I see this, once I see that the lows have been cleared out right here, I know that any retest for the buy is simply a sell. Any retest for the buy is simply a sell. Until the market tells me that, hey, we're now going into bullish markets. But you'll get better at it, and you'll know that how to stay in bullish markets forever and how to stay in bearish market, because there's other confluence too you can use. But just with this alone, you can hold trades for weeks, literally weeks. I mean weeks. So for instance, right here after this, I would have seen this turtle soup right here. After I noticed these highs were cleared, and then I'm like, okay, so are we in a sell model yet? Are we in a sell model? And I see this break. Once I see this break, I know that every single buy is simply a hedging antics to just sell. A buy is simply a hedging antic to sell. If you would have caught this move, you would have been like, you would have caught this like 400 pips. Every single buy is just a simple hedging for short. And where do they buy into? So let's actually look at this and see where they're buying. And remember how you need to understand what an order block, breaker block is and everything. So notice how they buy back into this order block. So when you're looking at this, you see this down candle here, and then you see this up move. Where you would do, you would actually start from here all the way up to here. The reason for that is because the last up move actually started from here, this bottom wick, and it bought up to here. That's the last final up move. Technically, I mean, last final up move is here, and then you wouldn't count this candle. So the 50% of that is right where they sold. Boom, right there, they hit it and sold. Right here as well. This is what? This is a repulsion candle. You want to see an instant rejection away from the 50%. So let's measure this real quick. Here's this is 23 pips, and the body is about 30 pips. This is about 3 pips, 23. The body is the main focus. So the body is the main focus. I'll go from the top of the body to the low of the body. Here's that 50%. Where would I be entering this then? I would enter the body and not the wick, because this is a body candle, not a wick. My stop loss, since I know I have a safety net now, my stop loss will be slightly above this guy right here, or I can even, if I feel comfortable, I can push my stop loss here. And I know every single buy that happens is simply a retest for the sell, because I know I'm in a sell model. Same thing right here. This is a repulsion candle right here. Notice, and this is a wick, actually. This is a wick repulsion candle. So from this to this, notice how the 50% was never violated. This confirms that this is in fact a repulsion candle. You saw price came and wick instantly, rejected, instantly rejected. And then the last down sell before you saw the move up is right here. This guy right here. So price came, this is a breaker block. So remember how I said the last down move before the successive buy, before an intense sell, this is the breaker block. You can still do this with the breaker too. Here's that 50% right here. Where would I have entered this trade? I would have entered right here on the wick. So right here, my stop loss would have been slightly here. I mean, that's a bit aggressive. And then my TP would have been targeting this low. If I noticed that my TP was never hit and I actually got stopped out, instantly, I'm like, okay, I may be going to a buy model. That's just one mistake out of the 1,000 wins that you've taken already. So just understanding the models that you're in. But let's go back to so that was a sell side model. This move was a sell side model. Remember how I said it always takes out the highs before it buys. This is the same thing with the buy side. Always takes out the lows before it buys. So it took out the low. Instantly, I know any sell that happens is simply a hedging opportunity for longs. So hedging right here, this is an order block. This whole move from this top candle to here is an order block. Why would I get in here and not down here? Because the reason for that is because this order block is heavily body. So I know that it's got to go through this guy, this guy, this guy to buy. There's no way it's going to come down here because most of the volume in this is heavily body. So I'm going to get in right here and I'm going long. And then the next retest, simply just a hedging. Same thing. This is also the order block before the slight buy. You get better at it and you start to see it. Price came down, hedging opportunity, and bought. Same thing right here, this guy right here. Look where it came, down into this what? Repulsion candle. This is majority what? Wick. So you can't tell, but the wick actually starts at the opening, even though there's no wick there, but that is a wick. In fact, a wick here, but it's the top of the body, but it's also the wick. So I would have gotten in at the top of this body. My stop loss would have been slightly here. And I would be long in this. I would be long until the market tells me I don't need to be long anymore. And you're catching like 300, 400 pips. And you could hold this for days. You could hold this for days, like days. In fact, you could have held this move for a couple of months, actually. You could have held this move for about 1,000 pips. Simple as that. And all you're doing is just adding more positions as you go too, because you know that every retest, every sell retest is simply a hedging opportunity for banks to add more longs. So they just hedge, they sell here, hedge, buy. Sell here, hedge, buy. Sell here, hedge, buy. They sold here, they're hedging, 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 buy, sold, buy, sold, buy. You would have entered here and you would have gotten out here. So this is from July of 2020 all the way to September. So imagine if you would have caught this 1,000 pips and you're adding more positions as you go. By the time you get to July, you're already up like 10,000, 20,000, 30,000. And this is how these people do it. So if you see these people who are holding positions for long periods of time, it's because they understand the internal and external liquidity and what side of the market they're on, and they know what to look for. So they're not stupid in the markets, and they know when to get out. So do you guys have any questions so far? So we'll actually look at this live right now. I'll look at this live and I'll show you what my moves are that I'm doing. So let's actually go into one of my trades. I'll go on my trading list and I'll start with gold. The reason why I'm in this gold short, I will show you guys why I'm in this gold short. So I start at the monthly. I always start at the monthly. And I mark out my monthly to see where I'm at in terms of the monthly, what the gold is looking for. So I know this gold came up. We came down. This move up is a repulsion candle. This, even though it's a black candle, it's the last move up. Notice how it touched the 50% rejected, came a little bit rejected. It's so simple to see where it's going next. It's obviously going to take out these lows because we rejected it so many times. But that's just the monthly. Let's confirm this on the weekly and the daily and eventually the hourly. So I always mark up where my highs are, my lows, and then where am I targeting? First line of defense is I target the monthly equilibrium level. So let's look at this. Where's the monthly equilibrium level? From this low. Actually, it's not this one. It's the overall equilibrium. So yeah, from this low, sorry, to this high. Is this correct? Oh, I'm tripping. I'm looking at the short-term equilibrium level right here. Sorry. This guy right here. So when you're looking at the monthly, you don't want to go too aggressive. You're looking at the short-term perspective. So there we go. So here's the short. Where's the other thing at? Yeah, so when you're doing the equilibrium level, you're going from body to body. So not the wicks. You go from a body, the most obvious body, to the most obvious wick. The reason for that is because the bodies are where most of the volume is, because this is just straight body. Now the 50% is here. Now I could highlight this area, but so the reason why I said this is internal liquidity is because I'm going to be buying, is selling internally to continue to buy. So I know that this retest is simply a retest on the monthly to probably go to the equilibrium level, or even to come down to here into this repulsion candle right here, where I would expect price to respect the 50%. If it does continue there, and then I would sell. So once I hit this monthly equilibrium level, I would be looking to go long to clear out these highs on a monthly perspective. So I'm already thinking ahead, like, okay, so I'm waiting for this. I'm trying to see this, and I want to target this, just like that. and then I go on a weekly perspective. So let's look at the weekly perspective. Weekly perspective, we came out, we took out these highs. These highs were liquidated right here, got cleared out, and then it dropped. So I know every other thing that comes down was a retest. So if I was, the reason why I'm switching to the sell side is this exact reason. On the monthly, I'm doing an internal run into, what is this right here? This is the fair value gap / liquidity void. So here's that fair value gap. You can't see it now, but this candle here, this wick is the fair value gap. Notice how it took out these lows. Once it took out these lows, I know that I am now in a sell side model. Why am I in a sell side model? Because this candle right here, this guy was respected for 3 weeks, 2, 3. So this guy is majority body. So majority body. So, and then they started shorting the market actually at the body of this candle. I mean, I wouldn't have gotten in just because the banks will do that sometimes and be greedy with their entries. And I would have gotten in here, but it didn't hit that. Notice how it came up. It touched the wick, and then it dropped. Touched the wick, touched the wick. Actually, the last down move, I'm an idiot. I just realized that you need to include the wick when you're talking about a wick order block. So this is included with this, and the 50% is right here. That is why they bought they sold at the wick. So they sold from right here, and then they just tank. Now I wouldn't be buying off the I wouldn't be buying or selling off the weekly, but this is just so you can understand that everything that happens is for a reason. So once they clear out these lows, I know that every single buy in here that's going to happen is simply a retest. Simply a retest. Now, if I would have saw this candle take out these highs, I'd have been like, I'm gonna stay out the market for a week just to see what it's doing to confirm that it's actually in the buy model. But we saw that rejection, and then it just rejected. And then this week came, respected this repulsion candle, respected this repulsion candle. It's so obvious where it's going next. It's taking out these lows to go for liquidity. Where's the liquidity? At the equilibrium. It's so obvious. And then let's look at the daily. So daily's next. We're looking at the daily. So here was that sell side. We came up. Notice how we came to this repulsion candle. The 50% was respected right there. Rejected. Bought up. Once we broke these highs, I'm like, okay, so we're now in the buy model. So even if I didn't get in the buy model down here, like for instance, these highs were broken. If I didn't get in the buy model there, I could have gotten in right here. So after this broke, any sell that happens is instantly my buy. So I could have been in this buy for like 8,000 pips. And where would I be targeting? These highs. There's liquidity above these highs. That's why they liquidated it here. And then I know my next idea would be, okay, any sells in here would be a retest. So it sold for a little bit, but it broke these lows. So instantly I'm like, okay, so this is actually, we're in a sell model now. So any buys in here, sell, take out these lows. Another buy, I would be iffy because this broke the high. And I'm like, okay, so maybe it's in the buy. But it never did that. We came up, broke this high, rejected it, broke it one time and rejected it, and then clear out these lows. It took out the lows right here, these lows. So now what are we in? We're obviously in a sell model, and it's gonna break. Any buys that happen in there, we're gonna retest, and then we're just gonna catch the sell to just clear out the external liquidity. So every time there's a retest, that is called internal liquidity run. If it's going for highs and lows, that is called an external liquidity run. You need to know the difference so you're not on the wrong side of the market. So right now we are on an external liquidity run. for these lows. Do you understand? That is why I am shorting gold to 1727. And people are like, what the hell? How do you see that? How do you know that? Because I'm using what I'm being taught or I know. So in simplicity and simple fact is, so right here too. So you can't see it now, but this was simply a retest for that continuation down. That's why I got in up here yesterday and I was like, oh, I'm selling gold because I knew that this buy was simply a retest because after we broke these lows, any buys that are in here. So let me highlight this actually. Any buys that are in here are simply retest. What's the first line of defense here? The breaker. This was that last down move before the successive buy, and then eventually it took out these lows. It's so obvious, it's almost like a slap to the face. Just knowing this will make you successful. You can hold trade for days. But once you understand price action and you understand like the seasonal tendencies, the IPDA, the SMT divergences, the other stuff, you can stay in trades for years. Like I literally was back testing this stuff. And I'm like, bro, I could literally get in a trade and hold it for like a year and probably get paid half a year. So every 6 months, I'll take profits. So like I'll start a little $1,000 account, drop a standard after a turtle soup, hold it for like a week, add another positions, hold it for a week, add another position, hold it for another week, until I'm like 3 months in. Because every 3 months there's a shift from buy side, from external to internal liquidity. So you need to understand that, but we will get better at that. So that's most of the stuff that I wanted to cover today. This is recorded, so I would really like if you guys could go back and actually watch it and see this unfolds, because your mind is going to be blown away once you understand or you can see what the hell I'm seeing. Because once you see it, you're like, I don't really care what other people are doing because I already know where it's going. I already know what the banks are doing because this is all just hedging. If you really look at it, they're all just hedging. They're just hedging their positions. Remember what I told you? Consolidation is what? Just a form of hedging. They're buying just to short. They're always going to buy before they short. They're always going to long before they short. They're always going to short before they buy. They always do that because they need to sell to willing participants before they buy, and they need to buy to willing participants before they sell. They will always do that. There's never a time where they will just, unless you're looking at divergences, SMT divergences, and it has to deal with internal liquidity for the benchmark, and then external liquidity for the other one. But we won't talk about benchmark or give me a second. We won't talk about benchmarks or where is quarterly shifts or ranges right now, because this one is more complicated. But you can just use this for now. We'll use this for now to just do what we need to do. But so far, yeah, that is all I wanted to talk about today. I do have a couple of emails and stuff to send out, so I will be quite busy. This is part 1 of the video. I will go back over this stuff on Friday as well, because it's good to go over it so we can continue. But do you guys have any questions so far? I hope I wasn't like too quick. I'm guessing you guys are probably doing something. So this is recorded. I'm gonna stop the sharing and then I'm gonna end the call. But thank you guys for coming and have a nice day.